Welcome back to the channel and thank you for joining me. Today we'll be talking about FuboTV, a super interesting company that has been on a roller coaster ride ever since coming public at $10 a share around October. In this video we will investigate how this stock went from surging 500% after its IPO to over the last week or so dropping 50%. We will look at what Fubo does, their catalysts, and what excites me about the company. And then we will also compare that to the flaws that the short side analysts are focusing on. If you want to know my plans for this stock, please stick around to the end, but make sure you watch the entire video to understand my rationale and investing thesis. Let's get into it. FuboTV is the leading sports-first live TV streaming platform, offering subscribers access to tens of thousands of live sporting events annually, as well as leading news and entertainment content. At the core of their offering is their proprietary data and technology platform optimized for TV and sports viewership. Their platform has enabled them to regularly offer new features and functionality for their subscribers and for their advertising partners. For example, they are the first virtual multi-channel video programming distributor, MVPD, make sure you remember that, to stream in 4K resolution. We also believe that FuboTV is the only MVPD where customers can watch 4 live streaming events simultaneously. Both 4K and multi-view particularly complement sports viewing, which is why we believe that FuboTV offers a differentiated and more personalized premium viewing experience for sports fans. Their financial model is driven by strong unit economics. The more they scale, the stronger the unit economics become. We expect margin improvement to continue to improve over time due to the number of initiatives that they have going on. This includes the growth of advertising on the platform, along with strong attachment rates on value-added services, such as cloud DVR storage and the ability to stream on multiple devices. Typically, value-added services like cloud DVR storage are a very high margin revenue. We've been saying that streaming is the future for a few years now, and this is definitely true, but although we've seen streaming adoption increase through the years, if we take a step back and look at an adoption S-curve, I think that, in my opinion, we are still in the early stages of adoption, especially when thinking about it on a global scale. In this chart right here, I am fairly confident that we are in this bubble area. So although we've seen a lot of growth in adoption of streaming services and we've seen some exponential growth, I think we are still on the cusp of going fully vertical and even more exponential on our adoption S-curve. There are many reasons of why this industry has not reached maturity yet and why it will continue to grow exponentially. One is an industry megatrend that is causing an increasing decline in traditional TV viewership as more and more people cut the cord and opt in for a more personalized and therefore more affordable option. Another reason is another industry megatrend that is seeing the shift of TV advertising dollars going to connected TVs. Current streaming powerhouses like Disney Plus and Netflix have truly benefited from these increasing industry trends. Netflix ended 2019 with 167 million subscribers, and as of Q3 2020, they had 195 million subscribers, which means that it's very likely that for the full year 2020, or rather that they ended 2020 with over 200 million subscribers. For Disney, the huge growth of their Disney Plus streaming service in 2020 has somehow managed to help the stock increase, even though Disney's core business segments like their cruises and their parks have been struggling all year due to the pandemic. The stock is up 45%, mainly due to its growth in the Disney Plus subscribers, reaching 86.8 million paid customers a little over a year after launch. That's very close to 90 million customers that Disney originally expected to land in year 4 of Disney Plus. So they are absolutely crushing their 2024 guidance and have in fact revised it from 60 to 90 million to about 230 to 260 million total paid subscribers in 2024 for Disney Plus. This insane growth witnessed by Disney Plus and Netflix is proof that the streaming industry is only picking up more steam and has a lot more room to run. Additionally, according to our research, this is not a winner-take-all industry, and we think that there are going to be many players that can succeed. So, you might ask, how has FuboTV been doing in 2020, while their peers have been absolutely crushing it? Well, for one, Fubo is not a multi-$100 billion company. It is a much younger company with much less subscribers, which is why it is only valued at around $2 billion. But these things don't matter much, as we really like to focus on the growth of some of their most important metrics. What really matters is how fast are revenues and the subscriber base growing. At what rate is advertising revenue growing? And another very important metric, ARPU, which stands for average revenue per user. This simply means that if ARPU is increasing, each user is paying you more now than they were previously paying you, which is a good sign of a strong and healthy business that continues to roll out and offer new features that their customers enjoy and pay up for. If we look at their Q3 announcement on November 10th, FuboTV skyrocketed and eventually hit $60 a share, mainly because of how great Q3 was. Revenues were $61.2 million, a 47% increase year over year on a pro forma basis, or 71% increase if we exclude their 2019 licensing revenue from the FaceBank AG business, which was sold in July 2020. Additionally, revenue in Q3 is up 38% sequentially compared to $33 million in Q2. This increase was driven by continued subscriber expansion, an increase in subscription average revenue per user, and growth of advertising sales. Subscription revenue increased 64% year over year to $53.4 million. Advertising revenue increased a staggering 153% year over year to $7.5 million. Paid subscribers at quarter end totaled 455,000, an increase of 58% year over year. Average revenue per user, or ARPU, per month was $67.70. This is up 14% year over year, which is really nice to see. Total content hours streamed by FuboTV users, paid and free trial, in the third quarter increased 83% year over year to 133 million hours. Monthly active users watched 121 hours per month on average in the quarter, an increase of 20% year over year. As you can see, fundamentally speaking, FuboTV is firing on all cylinders and growing in all their important metrics. To add to the great news, and perhaps what tipped the scale for me in deciding to invest in this company, is their recent announcement that they will be entering the online sports betting space with their acquisition of Balto Sports. FuboTV intends to leverage its own proprietary technology, along with Balto's contest automation software, to launch a free-to-play gaming offering. In connection with the deal, Balto's team will join FuboTV and will be instrumental in driving the company's expansion into both free-to-play gaming and online sports wagering. The online sports wagering market is expected to reach $155 billion by 2024, according to Zion Market Research. Another research report values the sports betting market at around $600 billion by 2027. If we look at DraftKings, the most prominent name in online sports gambling, they are currently valued at $18 billion with a price-to-sale ratio of 39 and their trailing 12-month revenue of $423 million. In comparison, FuboTV is a $1.9 billion company with a PS ratio of 17 on their trailing 12-month revenue of $111 million. So although FuboTV has about 1/4 the revenue that DraftKings has, they are surprisingly only 1/9 the size of DraftKings. But this is a comparison to an online sports gambling company. So, since FuboTV doesn't quite have that rolled out yet, let's see if we can compare their valuation to Netflix for a more relatable comparison on the streaming side. Netflix currently has an impressive market cap of $238 billion. With trailing revenues of $23.8 billion, this puts Netflix at a PS ratio of 10. Sure, we can look at this and say that FuboTV is overvalued on a PS basis compared to Netflix, but we also have to consider that Fubo is growing at a much faster pace than Netflix, which means higher revenue multiples is to be expected. Roku, another streaming media company that's been on a tear this year, is currently valued at $42 billion, which is 26 times their $1.5 billion trailing 12-month revenue. This compares to FuboTV's PS ratio of 17. So I feel like we've seen nothing but good news here, and yet the stock is down 55% from its all-time highs of $62 a share 2 weeks ago. This comes from a combination of price target reiterations, short seller reports that have come out since its all-time highs, as well as a healthy correction in the stock price due to its current quick run-up from $10 to $60. It all started with BMO Capital Markets pulling their buy recommendation once the stock went north of their $33 price target, which they also lifted to $50 per share. The next day, Lightshed Partners initiated a sell rating with a street low $8 per share, claiming that it was the most compelling short they have ever identified and adding that their sports betting segment is a pure fantasy. In my opinion, this sounds extremely irrational because they have not given the company a chance to execute on their online gaming platform. They did just announce sports betting last month, after all. A few days later, another short report comes out of Hedgeye, and they also called it their best idea short call. On December 30th, Carousel Capital was the latest FUBO short seller, calling its valuations completely unmoored from reality. Last but not least, FUBO hit its post-IPO lockup expiration. This means that about 88 million shares are becoming available for sale, more than tripling the share float. So what's with all this negative news, and how do we make sense of it? Well, here are my thoughts. In terms of the bear analysts and their short reports, one possible reason is that they saw how high this stock had run up and then decided to gang up and pick on FUBO with the intent to make some money on the last trading days of the year. And I'm sure they did just that. This does make me think, if they cover their short position to lock in profits before the last day of the year, will the stock jump up on Monday, January 4th, which is the first trading day of 2020? Despite the recent bear analysts, we still have reputable sources recommending the stock. The main one being investment bank Needham & Company, which was the first to initiate a bull price target that later got reiterated to $60 per share. Wedbush is another bull that initiated an outperform on the stock with a price target of $40 per share. The next reputable bullish source is the Motley Fool, who laid out its reasons to buy FUBO. One reason that stood out was the fact that, and I quote, "Sports has its own moat for live television." It's important to note that all these bull analysts I just mentioned came in the first half of December, which was also when the stock was going up day after day on its way to 60. Conversely, the stock was falling daily while bear analysts were initiating their short reports. So it seems like a bearish analyst will send the stock lower while a bullish report will send it higher. So with this in mind, how does one invest in FuboTV? Well, I think more often than not, most analyst reports, long or short, are pointless as oftentimes these firms have agendas or they are biased or they're trying to push a certain narrative that will benefit the firm. I think that the best thing to do is to try to pay attention to the underlying business fundamentals and try to ignore what the analysts are saying. At the end of the day, FuboTV operates in two massive red-hot industries that are experiencing strong tailwinds and are poised to continue increasing exponentially over the next 10 years. In my opinion, FUBO is in a unique position since they are focusing in a niche market like live sports. They have a great opportunity to create a flywheel effect with its upcoming play fantasy sports and live sports betting that can increase customer loyalty as well as customer engagement. I initially started my position in FuboTV at $38 a share, but this was a small position. I then added some more shares at $34 a share as well as at $30 a share on the last trading day of 2020. I think shares are very attractive at these levels, and I will continue to add more to my position if the stock opens up lower on the first day of 2021, which is Monday, January 4th. Streaming and gambling stocks often receive high valuations, and FuboTV is very sticky. I can see a lot of opportunities for them, not only in the US, but also globally. Thank you for staying until the end. I hope you really enjoyed this video. If you did, please make the like button turn blue and feel free to also subscribe to my channel and turn on the bell notification. See you on the next one.